Alright, so continuing off, this is part 2. Alright, so we just covered this block here from the sell and climax to the volume off the bottom, rally, to the pullback on the springboard with clustered closes, and then, the low volume pullback that it was on relative to the high volume rally. So that's what's covered, and I covered the triggers here. One at this low on an intraday level when strength comes in from an oversold climax. The second being the clustered closes. And the third being the breakout. Those were the 3 buy points that Wyckoff talked about. So now that's a quick summary of part 1. This is part 2. So let's go. Remember that we are now studying the average or composite price of 50 stocks, which is our chief guide as the direction of the trend. It is impractical for us to operate in all of these 50 stocks at the same time. That's not the case today, where you have the SPY and the ES. Therefore, we must select what we want to invest, and we want the ones that show the greatest technical strength at that time. So he's saying that back in the day you couldn't really buy the index. You couldn't buy the index as it's on the springboard. Well, now you can. At that time, what they would do is look for the best market. So if the index is on the springboard, let's take a look at the markets that are about to move the furthest, the fastest, and then just buy those stocks. Anyway, for this reason, we must turn to our group averages and our position sheet, which enable us to select the best out of our list of individual stocks in order to find the 1, 5, 10 or more stocks which promise to yield a large profit in a short amount of time. That's exactly what I'm just saying. So what is the point? Well, the market is on the springboard at this position. What are you going to do? You're going to go take a look at your groups and say, oh, you know what? This group looks like it's about to go the furthest and fastest. That is determined by the amount of pullback in that group and the amount of cause that it has built. Again, it's the pullback, the relative strength, meaning it doesn't pull back as much as the index, and how much of a cause it has built. Based on these two factors, which will be applied to the group as well as the stock, you pick the bunch of stocks that have that relative strength on that pullback and the biggest bases, and go long. So that's what he's saying all here. Next, having decided that the trend of the market is up, we must therefore continue to trade on the long side. He's trading with the market. Alright, he's trading with the market trend until there is indication of a change in trend or until the trend is in doubt. We must always be on guard against such changes, and when the trend is in doubt, we take a neutral position, that is, we are out of the market. For the next several days until January 9th, the market makes further progress to the bull side, recording 156.5 on that day, and observe that the closing figure of the 7th, 8th, 9th, 10th are within a range of about 1 point. So what he's saying is, the market breaks out, and then on the 7th, 8th, 7, 8, 9, 10, around here, what happened? What happened here? The market made no upward progress. Alright? So he's bringing in another concept. Alright, what is that concept? And let's compare it. So on the springboard, which was right here, the market was not making downward progress when comparing the closes. The last 3 bars here, closes are very tight. Here, he's taking a look at progress from the perspective of what? I think it's high to high to high to high. Alright, so it's making no upward progress as a net result of 4 days activities following the 6th. And they're all in the range of about a point. So the range from high to high to high is about 1 point. The daily volume shows that it's tapering off and there's lessening demand at the top. So the demand is not that much. It's not increasing. The conclusion is partly confirmed by the shortening of the upward thrust from the 3rd to the 7th. Alright, so comparing high to high to high to high, we see that it's not really able to make that much price progress, meaning the high today relative to yesterday is small. The high today relative to yesterday and the high yesterday relative to the day before is small in terms of the amount of progress from day to day. Today's high minus yesterday's high minus the day before, that high to high to high, the amount of the amount is small. Alright, so this is the first time we get introduced to the concept of shortening of the upward thrust. Alright. Indicating that it was hard work to advance the market. So shortening of the upward thrust on the top of this rally indicates that it's difficult to make new highs from bar to bar to bar. Okay, so where did it make a really nice high? Well, from this day, from that springboard to the next day, it's making a lot of progress in terms of not only the closes but the high to high. After that, not that much. After that, really good progress from high to high. You see that? High to high, really good progress. After that, you still have good progress right here from high to high. Here, nope. What happened? Flattened. See that? What about here to here? There is some progress, but surely not as much as that was near the breakout bar. Alright? So from high to high to high to high, we see that price is having difficulty in making progress. And so what he did was he introduced the concept of shortening of the thrust. Now the same could have been talked about, from low to low to low in a downtrend. Alright, so that's also, you can apply the same shortening of the downward thrust. Right here we have the shortening of the upward thrust is small because it's shortening. The upward thrust is from high to high to high. And what is it indicating? What does it mean? It means that it's hard work advancing the market. Buying now seems redundant to follow prices upward on the day when the high of 156.5 is recorded. The volume increases abruptly. So let's take a look at this on on this day. Alright, so this volume here increases on this day, right here. Volume increases abruptly compared with the volume of the preceding session at the same time that the price runs up to a new high only to close near the day's low. And actually below the close of the prior session, it's a red bar. High volume from the high. What does that mean? It means they're selling the high. Okay? So let's just put it in context of this bar. You see how it went down and then you had volume off the bottom and increasing volume? Now we have not exactly the same thing, but similar in that it's going up and then bang. That's the most amount of volume since this continuation. So since the continuation, we had a rally, price had a rally, the market had a rally, and the most amount of volume came in coming from a high, and it was a red bar. And what indication we have? We have a shortening of the thrust and then selling off the highs on increasing volume, more than the volume of this rally since the continuation bar, the progress in the closes. Okay, so now how he's piecemealing these little clues together to come up with a judgment. All of the foregoing is evidence to the approach of a corrective reaction, but we still hold our long position because there's no indication of important distribution. So he's expecting a pullback. Such a reaction begins on the 12th. 12. It's this right there. Can't really see it that clearly, but 6, 7. It's either this or this. Anyway, so at the top of the rally, what is it that you and me, what do we want to see? Well, you want to look for a shortening of the thrust, and you want to see heavy selling from the high, and you want to see a big red bar. All right, so that's what indications. But clearly the idea is to look for a shortening of the thrust because it would indicate that price is encountering supply and that it's having difficulty advancing. The other thing you want to look for is that, price goes up to a new high and it fails. The new high failed and it actually made a lower close. Okay, so it goes to a new high, can't hold it, and actually closes red and on increasing volume. So they found a spot to sell. Sellers are selling. Okay. I read the footnote about the 9th. The action of the 9th is an illustration of a typical buying climax. Alright, where is the 9th? Can't really see that very clearly. I think it's this. It's 1, 2. Must be one of them. Anyway, I think that's the bar. It says the action of the 9th is illustration of a buying climax, which is the reverse of a selling climax. Okay, but this is not the same as buying and selling climax that we're used to. This is the climax at the top or bottom of a swing. Alright, so climaxes are not just at the top or bottom of a trend. They're not just ending action of a trend. They can be the ending action of a swing as well. A very important concept, because a swing on one time frame can be a trend on a lower time frame. Okay, so just keep that in mind. And the concept of a climax is applicable to swings as well as trends. The action of the 9th is illustration of a typical buying climax, which is the reverse of selling climax. On this day, a poor quality of demand is being promptly overwhelmed by the superior force of supply of good quality. So that new high up there led to heavy selling. In other words, the bulls, realizing that they were encountering resistance to the advance because of that shortening of the thrust, break the stalemate of the 6th to the 8th by bidding prices up to attract those buyers who were too timid to come in before the advance to the 155, but who now fear that the market may get away from them because it's making a new high. So basically, what they did was trap breakout buyers. So that right there was a move to a new high. That new high attracted public participants who saw it making a new high and probably had FOMO. They got in, and the smart money sold it to them and got out. Sold it to them as the public participants went long on the new high. Thus, there is a concerted effort of public demand which gives the larger and shrewd operators their opportunity to dump part of their lines in a broad and active buying wave. Okay, so let's just go over this buying wave and what's going on, not only at technical level, but interpret it from the perspective of the CM versus the public. So we're on a springboard. The market has a continuation bar. It advances, breaks out. As it breaks out, it starts encountering resistance, and there is difficulty in making a new high. At that time, you see this indication with the shortening of the thrust from high to high to high. What eventually happens is, since it's a problem making highs here, the shrewd operator, the CM, wants to sell part of his line. Alright? So what he does here is say, okay, I'm having problems lifting prices. Let's do this. Let's bob it up. It bobs up, goes above other levels. People come in because they want to get in on that new high, want to buy that breakout. The smart money sells to the people, and this transition of shares from smart money to the public is clearly evidenced by the increase in volume right here. So this bar here is showing that transfer to a new high and selling into those, right above that level right there. Bing, right there. Sell it to them. So this is, I think later on he calls it made to order. You see? Thus, there is a concerted rush of public demand which gives the larger, and because it's making a new high, okay, public loves to buy new highs because they're driven by FOMO. Alright, oh man, what happened? Thus, there's a concerted effort by the public which gives the larger and shrewder operator the opportunity to dump part of his line on a broader and active buying wave made to order for that purpose. Made to order. Okay, so once the smart operator sees that he's having struggling here, there's a lot of hesitation. You have green, you have red, you have green, you have doji or red, then you have a green. You know what? Why don't we pop it up and put it in weak hands? That's what happens, and there's a transfer. And then after that, the market pulls back. Alright, now they'll probably get right back into in on the pullback. But the key to remember here is is not just the bar action, but what it means and how to interpret it. There's hesitation in part of the upswing. That hesitation in part of the upswing means there's a problem advancing the market. And so what you have is one more new high. The new high is made to order to distribute to the public. After that, you have this corrective action right back down. Alright, so I'm trying not to go over too much. I think I'm at 20 minutes, so I'm going to stop right here. I'll continue the rest in a separate video, try to make them short. But each video is going to cover behavior and the intricacies of all of this, so you know what to look for. Like now, obviously, what you're going to look for, one of the things you're going to look for on top of a swing is that hesitation, meaning that inability to make higher highs from bar to bar to bar at near the top of a swing. And then after that, you want to see a buying climax on top of a swing. Now you're probably saying, oh, I don't see this anywhere. So let me just give you some real examples before I close. Okay, so here it is, where we look for a buying climax and selling climax at the end of a swing. Okay, these are swing climaxes. All right, not the traditional trend-ending buying or selling climaxes, but the buying and selling climaxes that end or terminate swings. Okay. So basically, you want to see the end of a swing, and then you want to see a big bar, like this. But you know what? Let's look in a. Try to make it most obvious here. Where's my arrow? So this is your rally. This is your reaction. Can you say which would be the climax bar in here that ended the swing? It's this bar. You had a spring of that bar and rallied, right? Okay, now let's take a look at another example. This is your starting. This is your ending. Where is the bar that is at the end of the swing that terminated the move? That ended the swing. That was the selling climax for the end of a swing. That will be this bar. You see? To some degree it's this, but here you see this one this one got bigger right there. That's the biggest bar in the swing down, and then soon after you have this. Now on the buying wave, what is the biggest? At the top, it's this bar. Now why on a bar by bar, what is one way you tell that it's climactic? Usually that level doesn't hold. Okay, so you see immediately what happens. Price goes down immediately. It cannot hold. Price goes down. It can't hold. Bang. Just like this, it can't hold. It has to go green. Alright? So we'll see. So again, let's put that away. Basically what you're looking for is rally, pull back, and then after multiple bars down, you have a really big bar. Why can't I draw this? Alright, so I have to draw it at a slight angle. Alright, and this bar is bigger than the rest. So this would be the selling climax in a swing. Okay, in a swing. At the top, you might have it right up there. Okay, so and it's bigger than the rest. And how you know that this is climactic bars, I don't know if I have the volume on this. Where's the volume? Yeah, that shit is climactic. Look at that. Look at that. You see this? At the bottom of this swing, look at the size of that. See? And again, you know, it's increasing. Look, it goes down, bang, right there. So, increasing 1, 2, 3, 4. 1, 2, 3, bang, right there. You see? So the at the top or bottom of the swing, one of the things to look at is a climax bar, which will have widespread and typically big volume. And one way to what one of the other characteristics it will have is price will not really have good follow through after it. So over here you see a lack of follow through because you have this red bar, you have this right here, green bar right after it, can't follow through. Okay, sometimes it'll have a little bit of follow through and then a reversal, and what you have is that low is marked and eventually it springs and bang. Alright, over here again the same story. Where's the follow through? There's your climax. You have a slight dip, bing bing bing, boom, break. Find others. Here's also, but this one had good spread but not that much good volume. Yeah, but it was the biggest in 1, 2, 3, 4, like 4 or 5 bars when it pulled back. So we mark that low. It can't go below the low and then break. So on the upside over here, this bar looks climactic, has no follow through, and it's at the top of a swing. But you know what? There was just a correction, so I'm not going to use that one. This one maybe. You have 1, 2, 3, and then bang right here. This thrust, I bet from high to low range is bigger than the rest of the rally bars, and it doesn't have fall through. And it has increasing volume, bigger than what? 1, 2, 3, 4, 5. That's the biggest volume up to there. This is 1, 2. Right? Right there. Here too, you have the biggest volume. Look at this. The biggest volume, in the entire rally. So let's make a little, at the top of a swing and a bottom of a swing, you're looking for what? Big volume, widespread. Let's put this number 2. What else? Because those are the characteristics. 3, lack of follow through. Okay, which in other words is that's the area you want to mark for a reversal. See that? Alright, so these are the characteristics of a climax, but this is for the swing. Alright, climax bar, which is terminating action, a swing, ends a swing. Okay, and this is something most people, they haven't seen this behavior or they don't recognize it because they're so hell-bent on springs and upthrust, they don't realize all the other things. But as you can see right from his text here, when he, where's that fucking text? 1 second. I can't even find it. Okay. What he called a buying climax also terminated swings, not just trends. People have a very difficult idea of accepting that because they've been trained to think climax ends trends. Here, this down bar is climactic. You have big volume, big spread, and it has no follow through. The next day, price goes up. So if you mark the low, it did dip below and then it reversed. By follow through, I mean like, it's able to, there's a continuing red bar down that continues to close low and continues basically. But instead, this is what happened. Okay. And then when it pulled back, do we have, no, I don't see it. At the top here, this would be the climax bar that ended the uptrend. Not the uptrend, the upswing. Why? Because it's a way of distributing to weak hands who love to buy new highs. Okay, price had difficulty going higher, so if it's having difficulty going higher, let's sell it to weak hands, meaning the public, by creating a climactic bar that people jump on board for whatever reason. This was a new high swing, a new high, and people got in. But remember, it can be on both the this is your upswing, and it also occurred here. Increasing volume, lack of follow through, and we'll cover this bar later. But again, the idea is that there's a climax bar or climax that is ending action for the swing, alright? Not just the trend. Okay guys, I'm done. Take care, bye.